Okay, let's unpack this. There's been a pretty significant development shaking things up a bit.
Yeah, you're talking about Barclays, right? The UK bank.
Exactly. Barclays.
Yeah.
They've just announced they're blocking all cryptocurrency purchases made with their credit cards. Big move.
A very big move. And it's not just that they're doing it, it's the why that's really telling.
Right. It sort of reveals this ongoing tension, the split between traditional finance and, well, the whole crypto world.
Absolutely. And it has real implications for you, the consumer. Plus, there's this fascinating, almost paradoxical element to Barclays' own strategy we need to get into.
Okay, so let's dive in. The core decision first. What are the specifics here?
So the policy is pretty clear-cut. Starting June 27th, 2025, no more buying crypto with a Barclays credit card. Attempt blocked. That's it.
And their official reason, what are they saying?
Well, they're pointing directly at market volatility, the wild price swings in crypto.
Yeah.
Their argument is that these sudden drops could leave cardholders, well, unable to pay back the money they borrowed on the card. It's framed as a consumer debt risk issue.
So it's about protecting the customer from getting into debt they can't handle because of crypto's ups and downs.
That's the main rationale they've put forward, protecting their cardholders.
But is that the whole picture? I mean, it feels like there might be more to it. Are they mentioning anything about, say, regulatory safeguards? Or lack thereof?
Oh, definitely. That's a key part of their statement. They explicitly contrast crypto with traditional investments.
How so?
They point out that crypto purchases aren't covered by things like the Financial Ombudsman Service, the body that handles disputes.
Right, the dispute resolution people.
Exactly. Or the Financial Services Compensation Scheme, which is the safety net if a financial firm goes bust.
Ah, okay. So no FSCS protection. That's a big difference.
It is. So Barclays is essentially saying, look, these assets are volatile and you don't have the usual protections, so we're stepping in to prevent potential harm.
That makes sense from their perspective. But, this doesn't feel like it came out of nowhere.
Not at all.
This feels like, well, the latest chapter in a long story, doesn't it? This kind of push and pull between UK banks and digital assets.
Yeah, it's definitely part of a pattern, a consistent stance, really, not some sudden shift.
I remember.
Yeah.
Wasn't there a big fuss back in 2021, something on Reddit? A Barclays customer.
Oh, yeah, I remember that. A longtime customer tried to send money to Crypto.com, passed all the security checks.
And then what happened?
Barclays froze the account, put it under a 15-day review, citing protection as the reason.
Protection. That sounds familiar.
It does. And it caused a huge backlash at the time because people pointed out, well, what about other high-risk things?
Like gambling.
Exactly. Gambling transactions weren't getting that kind of scrutiny, so it looked like, selective enforcement.
Interesting. So this new credit card ban fits that skeptical history. And they're not alone in this, are they?
Far from it. They're joining quite a club, actually. Think JP Morgan, Bank of America, Chase UK, Starling Bank, too.
All major players.
Yep, all of whom have either completely blocked crypto buys or put really tight limits on them.
So a clear trend among the big traditional banks. But what's the reaction been like from, say, the wider payments industry or crypto advocates? Is everyone just accepting this?
Definitely not universal acceptance. The reaction's quite split, as you'd expect.
Okay.
You've got groups like the Payments Association. Historically, they've really pushed back against these kinds of blanket crypto bans.
Why? What's their argument?
They argue it's unfair to lump all digital assets in the same category as, say, gambling. Their policy head, Riccardo Tordera Ricci, actually challenged a proposed UK government crackdown on credit card crypto buys back in 2023.
Oh, really? What did he say?
His point was basically about consumer choice. He said consumers should be trusted to make informed decisions within their existing credit limits. Let people decide for themselves, essentially.
That's a strong argument for autonomy.
Yeah.
But the practical effect of Barclays' move is clear, right? Fewer easy ways for UK folks to buy crypto, especially using credit.
Undeniably. It reduces those mainstream on-ramps, as they're often called.
So, if you're in the UK and your bank, like Barclays, shuts off the credit card route, what are your options? Where do you go?
Well, it gets trickier. Some banks, like RBS, are apparently still relatively open, But others, like NatWest and Metro Bank, have also tightened up or blocked transactions.
So fewer banks are playing ball.
Right, so your alternatives might be switching to debit card payments, if your bank allows that,
Right.
or using third-party payment methods.
Like Apple Pay or Google Pay. Do they work?
Sometimes they can act as an intermediary, yeah. Or you look at platforms like MoonPay. They offer non-custodial services.
Meaning you hold your own keys, right?
Yeah.
Not the platform.
Exactly. You control your assets directly. And platforms like that sometimes have better success rates with different payment methods.
But this raises that question you mentioned earlier.
Mhm.
If the banks say they're doing this for consumer protection, how safe are these alternatives? Do they have the same safeguards? Or are users just pushed into potentially less regulated spaces?
That's the million-dollar client, isn't it? It's a complex trade-off. You gain access, maybe, but potentially lose some of the oversight or simpler dispute resolution you might theoretically get through a major bank, even if they are blocking crypto now.
It really puts the onus on the individual user to be even more careful.
Oh.
Okay, but here's the twist. The part that feels, well, contradictory.
The paradox.
Yes. We have Barclays clamping down hard on retail customers using credit cards for crypto, citing risk and protection. But then you look at what Barclays is doing behind the scenes on the institutional side. It's a completely different story, isn't it?
It really is a stark contrast. While they're restricting retail access, Barclays itself has been actively exploring and even using blockchain technology for big institutional purposes for years.
Like what? Can you give an example?
Sure. Go back to 2017, their CTO was already talking publicly about piloting private permissioned blockchains.
So not public like Bitcoin,
Yeah.
but controlled networks.
Exactly. Controlled networks aimed at making complex things like trade finance more efficient, streamlining the paperwork and processes involved in international trade.
Okay, that was a while ago, though. Anything more recent?
Absolutely. Just recently, they were part of a really significant institutional trade. They used JP Morgan's Onyx network.
Onyx, what's that?
It's JP Morgan's system that uses tokenized collateral, basically representing real-world assets like bonds or cash digitally on a blockchain to make moving them between big institutions like Barclays and BlackRock much faster and smoother.
Wow. So they're using the very tech related to crypto just for themselves, for the big players.
Precisely. They're involved in these cutting-edge institutional blockchain applications, streamlining multi-million-dollar transactions. It shows a deep engagement with the underlying technology, just not for retail crypto buying on credit.
So let's try and tie this all together then. What are we actually seeing here, it feels like? Like two different worlds within the same bank.
It really does. You've got this cautious, almost paternalistic approach to retail crypto. It's too risky. We must protect you. Lots of restrictions.
Right. Keep the little guy away from the volatility using borrowed money.
But then, on the institutional side, it's full steam ahead, embracing blockchain, tokenization, finding efficiencies, participating in major platform developments.
It suggests they see value in the technology, just maybe not in the decentralized, permissionless assets for the average person, or at least not bought with their credit lines.
That seems to be the message, yeah. Is they want the blockchain efficiency for their own institutional plumbing, but they're wary of the unpredictable vehicle, the retail crypto asset, especially when fueled by credit.
So this deep dive really shows that dual narrative, doesn't it? Caution on one hand, innovation on the other. It tells us a lot about how complex this whole integration of new tech into old systems really is.
It absolutely does. And understanding the split is important for you, the listener, because it shapes the financial landscape you navigate. It shows how risk is viewed differently depending on who is taking it and how.
Which leads us to that final thought, that question to leave you with. What does this split personality, restrictive on retail, innovative on institutional, actually tell us about how traditional finance views the future of digital assets? And maybe more importantly, who they see that future being for.
Is it just caution? Is it about maintaining control? Or is it a calculated strategy, one set of rules for Main Street, another for Wall Street?
Something to definitely think about.